Deposit flightiness and quantitative easing, understanding financial stability and monetary policy, exploring key concepts of monetary policy impact. Agenda: Introduction to deposit flightiness, impact of deposit flightiness on financial institutions, understanding quantitative easing and its effects on the economy, interrelation between deposit flightiness and quantitative easing. Concept of deposit flightiness. Deposit flightiness refers to the mass withdrawal of deposits by bank customers, often triggered by fear of loss or confidence in the bank. Impact on liquidity. When many depositors withdraw funds at once, banks face liquidity challenges that can threaten their operational stability. Consequences for financial system. Deposit flightiness can lead to broader financial instability, affecting not just individual banks, but the entire financial system. Historical examples of deposit flightiness. The Great Depression. The Great Depression saw widespread bank withdrawals due to panic and loss of confidence in the banking system. 2008 financial crisis. 2008 financial crisis led to significant deposit flightiness, causing banks to face severe liquidity issues. Consequences of panic. Withdrawal panic can destabilize financial institutions and lead to broader economic downturns. Causes and triggers of deposit flightiness. Economic downturns. Economic downturns can lead to a lack of confidence in banks, causing depositors to withdraw funds rapidly. Banking scandals. Banking scandals erode public trust, prompting depositors to withdraw money from perceived unstable institutions. Geopolitical events. Geopolitical events can create uncertainty, leading to fluctuations in deposit levels as people seek safer options. Effects on bank liquidity and solvency. Depositor withdrawals. Mass withdrawals from depositors create immediate liquidity pressures for banks, impacting their cash reserves. Liquidity pressures. Banks experience liquidity pressures when they cannot access enough cash to meet withdrawal demands, risking insolvency. Risk of insolvency. Without proper management of liquidity, banks may face insolvency, losing the ability to fulfill their financial obligations. Consequences for financial markets and stability. Impact of deposit flightiness. The sudden withdrawal of funds can spark a wave of financial instability, affecting market confidence significantly. Loss of investor confidence. Withdrawal of deposits often leads to a decrease in investor confidence, causing increased market volatility. Systemic risks in markets. Deposit flightiness can introduce systemic risks that may destabilize not only individual institutions, but entire financial systems. Mitigation strategies and regulatory responses. Enhanced liquidity requirements. Enhanced liquidity requirements are implemented to ensure financial institutions can meet withdrawal demands and maintain stability. Deposit insurance schemes. Establishment of deposit insurance schemes protects depositors and boosts confidence in the banking system during economic uncertainty. Confidence in financial system. These regulatory strategies are designed to bolster confidence in the financial system and mitigate risks of deposit flightiness. Definition and purpose of quantitative easing. Understanding quantitative easing. Quantitative easing, QE, is a monetary policy where the central bank buys financial assets to boost liquidity in the economy. Lowering interest rates. The main goal of QE is to lower interest rates, making borrowing cheaper for individuals and businesses. Promoting lending and investment. QE aims to encourage lending and investment, particularly during economic downturns, to stimulate growth and recovery. Historical instances of quantitative easing. Federal Reserve and 2008 crisis. The Federal Reserve implemented quantitative easing during the 2008 financial crisis to stabilize the economy and promote recovery. Bank of Japan and deflation. The Bank of Japan utilized quantitative easing to combat persistent deflation and stimulate economic growth in the region. Applications of QE. Quantitative easing has been applied in various contexts, demonstrating its role in addressing different economic challenges globally. Quantitative easing and its effects on the economy. Impact on interest rates and inflation. Quantitative easing effects. Quantitative easing is a monetary policy that lowers interest rates, aiming to stimulate economic growth. Interest rate trends. Lower interest rates can incentivize borrowing, impacting consumer spending and business investment positively. Inflation implications. Higher inflation can result from prolonged low interest rates, affecting purchasing power and cost of living. Influence on asset prices and investment. Impact of QE on asset prices. Quantitative easing QE tends to drive up asset prices by lowering interest rates, making borrowing more affordable. Encouragement of investment. Lower borrowing costs encourage businesses and individuals to invest, stimulating economic growth. Risk of asset bubbles. If not managed properly, the influx of capital can lead to asset bubbles, posing risks to the economy. Long-term economic implications. Increased debt levels. Quantitative easing can lead to higher debt levels, which may pose challenges for long-term economic stability. Inflation risks. One of the potential challenges of QE is the risk of inflation, which can erode purchasing power over time. Policymaker considerations. Policymakers must carefully consider the long-term implications of QE when shaping economic policy to mitigate risks. Quantitative easing as a measure to counteract deposit flightiness. Role of quantitative easing. Quantitative easing is a monetary policy that aims to increase liquidity in the banking system during economic downturns. Providing liquidity. Or purchasing assets, QE provides banks with the liquidity they need to stabilize their operations and encourage lending. Reinforcing confidence. QE helps to restore confidence in the financial system by demonstrating the central bank's commitment to ensuring stability during crisis. Case studies of quantitative easing during financial crisis. 2008 financial crisis. During the 2008 financial crisis, quantitative easing was extensively used by central banks to inject liquidity into the economy and promote recovery. COVID-19 pandemic response. The COVID-19 pandemic prompted significant quantitative easing measures, helping to stabilize markets and support economic growth during unprecedented times. Central banks strategies. Central banks have employed various quantitative easing strategies to manage economic downturns and maintain financial stability in turbulent periods. Future outlook and policy considerations. Deposit flightiness. Deposit flightiness refers to the volatility of deposits in the banking system, which can impact financial stability. Quantitative easing. Quantitative easing is a monetary policy aimed at stimulating the economy by increasing money supply and lowering interest rates. Managing inflation risks. Balancing growth stimulation and inflation management is crucial for sustainable economic policies in the future. Conclusion. Understanding deposit flightiness. Deposit flightiness refers to the rapid withdrawal of funds from banks, impacting liquidity and stability in the financial system. Role of quantitative easing. Quantitative easing is a monetary policy tool used to stimulate the economy by increasing money supply and encouraging lending. Impact on financial stability. Both deposit flightiness and quantitative easing play significant roles in maintaining or disrupting financial stability within economies. Thank you.